Hi, good afternoon from a sunny Wirral. Hope everyone's having a great day. I'm just been catching up on some reading on different news and news that's coming out about property, and I've come across an article on Property Wire. So before I talk about this, all credit and full credit to Property Wire for this article. It's not my article, it's theirs, but I have a take on this article. Okay, so what Property Wire has said is house price. That they're saying that house price growth is driven by the north of the country, particularly the northwest and northeast. So house price growth in northern regions of England has outstripped the rest, suggesting they are closing the gap on more expensive areas. Yeah, at the moment I'd say they're right. Potentially it is closing the gap. But I have my own take on this, and I'll come to my own take in a little bit. This brings the average price to £211,977 in the northwest and 160,000 to 452,000 in the northeast. I don't know where they get these prices from. My property's half that price, at least half that price. Well, these are this data has come from the UK House Price Index. Last house I bought was 76,300 or something like that, I think. Jonathan Hopper, chief executive of consultancy firm Garrington Property Finance, said, in England, the northwest and northeast continues to jostle for the dubious honour of the region with the fastest rising prices. I think the northwest has slowed down, by the way. It might still be rising fast in other areas. I think it's definitely slowing down. I can't speak to northwest. Northeast. I don't deal with the northeast. And he goes on to say, in contrast, London prices increased by just 1.7% annually, while they fell 1.1% month on month. I think the fall's been more than that in some parts of London, specifically Chelsea and some of the higher end areas. Across the UK as a whole, prices rose by 5.4% to an average of £268,313 year on year in February, indicating the market is still seeing stable growth. I think it is seeing stable growth, but I think it's seeing slower stable growth. I think it's only seeing this stable growth in the north at the moment. I do feel that property prices are starting to fall down in parts of London. And I'll come on to my theory in a minute, and it's something that I thought of for quite a while. It's been my theory for quite a while, and I was at a seminar with Kevin McDonald, who's one of the trainers for Progressive Property, and he was saying the same thing as me, and I thought, yeah, he's spot on with that. And it's the ripple effect, and I'll come to it a little bit later, but that's what I'm talking about. So across the UK, whole prices, I've gone through that bit. So Tim Parks, chief executive of investment services for Raw Capital Partners, said, Trump's tariffs have reshaped the financial landscape, and the impact on stocks and shares has been well documented. Yeah, so basically Trump has tanked the dollar and the stock market, most other stock markets, and put a lot of people's pensions at risk. Could this prompt a flight to stability? So are people going to go from the stock market and start investing in property? Yeah, could be. Yeah, but not just at this moment. If so, as today's figures demonstrate, the UK property market could be a beneficiary, with bricks and mortar investments holding their appeal. And bricks and mortar have always been the safest investments. They will always, over time, give you capital appreciation. They might zigzag in, over time. You might see, in the short term, zigzag like that, and there might be dips and troughs. But over time, it goes all the way up like that. So yes, it could do, as opposed to gold. Well, gold is if it's an investment, it's a very long-term investment. But what it is a way of storing wealth rather than an investment. So if you invest in gold, you tend to be not too happy with the banks, and you think the banks are at risk, you're going to put your money into gold. That's why you've seen gold prices skyrocket over the last couple of weeks since Trump had his meltdown and threw these tariffs into the equation. And from what I was reading, the stock market was still tanking earlier on, or certainly yesterday as well. So that people, what they're saying is, yeah, bricks and mortar could fuel house prices, and I think they may be right, but not just yet. At the same time, expectations the Bank of England may need to cut interest rates. Possibly. particularly if a trade war translates into a global recession, maybe. And these are already feeding into falling mortgage rates. So you're seeing there's quite a bit of competition with the lenders for rates, and they're dropping the rates, not significantly, but they are dropping their rates, and so you're getting better deals out there. In fact, I'm just looking to remortgage one of mine at the moment, so I've just been in touch with my broker. Now, my theory on this is, I think the prices are still rising in the northeast and northwest. However, they are definitely dropping in parts of London. And the reason for that is I think prices have risen to a point where it is not an investment. So the money has travelled north. It's that ripple effect. So it's not efficient to rent in Chelsea, to buy in Chelsea. Let's go a bit further north and further north and further north until it progresses right to the top. And what you will find is that, and let's take microeconomies out of the question. There are microeconomies. I live in one on Wirral. Parts of Wirral are very, very sought after to live in. Not where I live, obviously, but other places. And that drives price growth in Wirral. It's a microeconomy. It's not as subject to inflation and fluctuations and tariffs, etc. So take them. But as a general law, prices, definitely pushed up there. However, with that ripple effect, as the prices go up, it'll become that they're not investments anymore. It'll get to a certain point where you need the figures to make it a deal. The figures are going to stack up. If the figures don't stack up, it's not a deal. So it'll come to a point where the prices have got to a point where they're not enough of a deal for most investors. And that's where you'll see the fall off. And don't forget, there's a lot more property coming to the market now, with landlords worried about EPC changes, the Renters' Rights Bill. So you get a lot more property and that on the market up in the northwest and northeast, and that will affect prices. If there's more choice, prices will drop. It's competition, isn't it? It's going to go down. So I think you'll see that as well. There'll be a lot of choices out there. People will go they'll pick the best ones out of it, and they'll look for the best deals. And you'll see prices have to come down because people, well, I go here and get a little bit cheaper. If someone wants to sell a house, that's my theory. Shoot me down on it. I don't care. That's what I think. I attended a seminar with Kevin McDonald, and he had that same theory that we're in the process of a crash, and the crash is happening in London. And it ripples out. I say, Kevin, you're spot on with that, mate. Totally agree. I think with the influx of more properties to the market, with landlords jumping out, there's a lot more properties around. Prices will drop. They have to. More competition for sales. It's not going to drive prices up. It'll drive it down. That's my theory anyway. There's a ripple effect here. Prices will not continue to rise rapidly in the northeast and northwest. There will come a point in time where they will drop again, and then people will buy and buy. But that's in the future. When I can't predict that, but that's my theory. Anyway, that's all for me for today. Have a great day. Keep moving forward. Keep doing property.